I'm Jim Eisner, Director of Media Relations at Harvard Business School. Welcome to an HBS Working Knowledge podcast. 2006 has been a banner year for leveraged buyouts, LBOs, where public companies are bought and taken private by a private equity firm or a consortium of firms. Qantas, the Australian airline, was recently taken over for more than $8 billion. Other big deals have involved Hertz, radio powerhouse Clear Channel Communications, real estate giant Equity Office Properties, and wealth manager U.S. Trust. Enormous amounts of money are involved. On just one day of deals in November, the price tag totaled $52 billion. What's going on here? To find out, I'm joined by Harvard Business School professor and private equity venture capital expert Josh Lerner, author or co-author of such books as The Money of Invention and Innovation and Its Discontents. Josh, what's going on here? Are we in some sort of perfect storm, financially speaking?
Well, I think there's really been a convergence of three things that have taken place that have led to the real upsurge that we've seen in private equity activity. On the one hand, we've had a big influx of money on the equity side. That we have many institutional investors, both in the United States, such as state pension funds, and overseas, many of the government investment corporations, as well as pension funds, have gotten very interested in trying to boost the kind of yields they get from their equity investments. That there's a sense that stocks, while they've done respectably, have not done spectacularly, and to get the kind of returns that they want, they're going to need to get something extra. So as a result, they've been very hungry to look at alternatives, and such as hedge funds, but certainly private equity has been a major focus. Secondly, we've seen debt providers become very active in this space. No longer is it just simply banks providing the debt for leveraged buyouts, but now hedge funds are playing an increasingly important role at providing debt, and as a result, the private equity investors are able to borrow, in many cases, more money and borrow it on more favorable terms than they were before.
Josh, what kind of ratios are we talking about, just to follow up on your point, as far as how much the fund is putting in, or the firm is putting in, and how much is leveraged?
Well, I think there's two things that we can point out here. One is that certainly we're not seeing a return to the 1980s, where you often had capital structures that were 90 or 95% debt and only a tiny sliver of equity. But we are certainly seeing more debt being involved in these, and often it's measured in terms of the ratio of the debt being taken on to the earnings, or the earnings pre-tax and pre-interest of a firm. And those levels have creeped up quite significantly over the last few years. The final change that we've seen has also been not so much in the supply of capital, but in the demand for capital. And in particular, for a variety of reasons, it's become tougher to be a public company. So as a result, many CEOs and many divisional managers have decided that rather than living a miserable life as a public company, they'd rather hook up with a private equity group and move to a status of a private firm.
So following up on that point, does Sarbanes-Oxley have something to do with this movement toward LBOs?
Well, I think it's fair to say that when we look at the changes that have happened that have made being a public company more challenging, there's a number of things that have gone on simultaneously. Certainly one of them has been Sarbanes-Oxley, in the sense that clearly being a small public company is now more challenging simply because of the weight of paperwork and the amount of outside monitoring that needs to be done. But there are a variety of other considerations as well, such as the depletion of the ranks of analysts in investment banks, as well as just simply the continued presence of a substantial amount of shareholder litigation. And all these things together have made it more challenging to be a public company and made it more attractive to get bought out by LBO firms.
Now, some people are concerned that when these deals are being done, numbers of private equity firms are getting together to do the deals because they're so big. And there are folks who accuse the firms of collusion. But in a recent Wall Street Journal op-ed piece, you argued against that.
Well, I think that it's important to realize that syndication, or clubbing as it's sometimes called, or sharing of transactions, has some very powerful rationales to it. And in particular, when we look at the venture capital industry, for instance, where this has been a practice that has gone on for many decades, we see that there's a whole series of benefits that come about from sharing of transactions. It allows people to share their judgment before the investment is made, as well as providing better oversight to the companies after the transaction is completed. Furthermore, it allows people to undertake bigger transactions than they could otherwise. So I think my worry is that if we, clearly if there's been, illegal behavior, it would be important to address it. But at the same time, we have to realize that this is actually a very beneficial behavior in many respects, and that we shouldn't throw out the baby with the bathwater.
Now, let me get into this movement toward LBOs. Professor Emeritus at Harvard Business School, Mike Jensen, wrote a very famous article a number of years ago called "The Eclipse of the Public Corporation," in which he said that, and I'll quote here, the publicly held corporation has outlived its usefulness in many sectors of the economy. With all these LBOs, are we perhaps headed in that direction?
I think it's a great question. I mean, Mike Jensen's piece at the time it was written was, in some sense, very prescient in terms of anticipating the rise of the buyout/private equity industry that we've seen in the past few years. At the same time, I guess I would quibble somewhat with the conclusion that we were going to end up in a world where everything was going to be privately held. I think that it's important to recognize that even though the buyout industry, or the LBO of the private equity industry, is much bigger today than it was 10 or 20 years ago, it still remains...
Yeah, he wrote the article in 1989.
Right. And certainly the business is much larger than it is today, than it was then. It still remains pretty small relative to the public markets as a whole. And that in many senses, when one looks at buyout investments, what one sees is that one of the ways that successful buyout investments, such as the Hertz transaction you alluded to before, actually get exited, is by essentially taking these back to the public marketplace. That one way to understand what the private equity groups are doing is that it's a kind of intensive therapy, and once the companies are cured, or the problems and issues are addressed and the operations are improved, then essentially the companies are ready to go back to the public marketplace. So in some sense, there seems to be a real symbiosis between private equity firms on the one hand and public firms on the other.
And that's where the payout comes for the private equity firms, when they bring the company back into the public marketplace.
Certainly, private equity groups can exit investments in a number of different ways. So certainly there are examples where companies will be sold, and essentially where a corporation will decide to acquire the business out of the portfolio of a private equity group. But certainly many of the very successful transactions have been exited by a process which is called often a reverse leverage buyout, or a reverse LBO, where essentially the shares are once again sold to public investors of the new and improved firm.
And there's a time element in there. You've done some research on this, and I understand there's a time element that if you do it fairly quickly, the chances are you're not going to do so well, but if you wait longer, you may outperform the marketplace. Is that correct?
Well, there's been a lot of discussion in the business press about reverse leverage buyouts, and often the commentary has been had a bit of cynical flavor to it, saying if the private equity guys are selling it, it must be overpriced, so don't invest in these things. And I was just very curious as to whether these claims, which you can read in many of the most esteemed business periodicals in the nation, really were borne out when one went and looked at the data. So a recent project that I did with Jerry Cow, a doctoral student at Boston College, and Jerry and I looked at what happened to offerings that were done from the early 1980s to the mid-1990s, mid-2000s, and saw how these offerings ended up performing in terms of what were the returns if you bought after the company had gone public and held those shares. And what we found is that despite all the implications in the business press, by and large, you ended up doing quite well as investments. That not only did they outperform other IPOs, but they actually outperformed the market as a whole. But there is one difference, and that has to do with how long the private equity groups held the company from the time of the LBO to the reverse LBO, or the IPO of a company. And in particular, as long as the holding period was more than 1 year, there was quite significant outperformance of the market. When you looked at the ones which sometimes are termed quick flips, or the ones where the group held it from less than a year from the buyout to the reverse LBO, it seemed that there was evidence that these actually underperformed the market in the years after the offering.
So much for the firms themselves. What about the taken over company and the workers in that company? What typically happens to a company when it gets LBO'd, if you will?
That's a great question, because in particularly during the 1980s, during the first wave of private equity activity, there was a lot of concern and controversy about the consequences of these transactions. And I think today, if one goes to a country like Germany or Korea, you also see a lot of controversy and a lot of discussion as to whether these buyouts, even if they generate good financial returns, are good for the economy as a whole. There have been some studies of this question, not as many as one would like. And in general, they've painted, though, a relatively positive picture. While certainly there have been examples of companies that have gone belly up after transactions have been completed, when they got too much debt on their balance sheets. By and large, the picture seems to be that the companies which undergo buyouts seem to do quite well and to prosper, that this process of restructuring, even though it's often painful in the short run, ends up being very healthy for the companies. I think more generally, when we ask the question of what's the impact of private equity, we have to sort of view this again as sort of a process of therapy, and saying that if indeed one was sick and, for instance, had a tumor, the process of treating it is in many cases a very unpleasant and painful one, but we're sort of much better for having done that in terms of our long run health. And I think in the same way, an economy where essentially firms that are underperforming where investors can come in and restructure them, ends up being a much more healthy than an economy such as France, let's say, where so often it seems that underperforming companies have been protected and subsidized rather than going through the harsh but necessary process of restructuring.
So if one of these LBOs does go belly up, you don't foresee the government rushing in to save the day?
No, I think there were many examples during the late 1980s and early 1990s where buyout transactions did get into trouble. And I think it's important to note that while certainly the process of restructuring these failed LBOs was a painful one, it was very different from some of the very visible examples we've had where hedge funds have gotten into trouble and there's been broad systematic effects through the financial system. Here, essentially because one has a single company, there are going to be impacts on the debt holders and on the bond holders, but it's unlikely to have those kind of broad ripples through the economy that one can encounter when other financial institutions get into trouble.
Finally, Josh, do you think we'll be seeing this kind of frenetic activity continuing into the new year?
It's a great question, Jim, and obviously it's hard to look into the crystal ball with definitive certainty. I think in the short run, we're likely to see a continued hectic pace in terms of buyout activity. In the longer run, it seems like almost any other market cycle that we see, that there's almost inevitable that there'll be some ebbing of activity. And in particular, as I alluded to before, much of the growth that we've seen has been dependent on the kindness of the debt markets in terms of being able to provide a lot of financing. And my suspicion will be that over the next couple of years, we'll see at least somewhat of a tightening there in terms of the availability of credit for these transactions. And that will at least lead to a moderation in terms of the pace of private equity transactions.
Well, we'll see how clear your crystal ball is. Josh, thanks for coming in.
My pleasure.